3 days ago, an alarm bell went off announcing the start of the global monetary reset. America, Japan, Germany, France, Britain are all of a sudden paying more to borrow money than at any point since the 2008 financial crisis. They are desperate for money, but nobody wants to lend it to them. Now, that sounds like something that only matters to governments. It doesn't. It impacts you directly. Your portfolio, your retirement account, your kids' college fund, and even your job. Everyone is sat waiting for a global monetary reset, some announcement, a new currency, a day that it all happens. But it's already started and you are the reset. Today we need to talk about three things. Who used to fund America, who stopped funding America, and who is holding all of the debt now, and most importantly, why you are the reset. You need to know this so you can protect your finances. Let's figure this out together. So America owes around about $40 trillion in debt. It's a huge number. It's hard to quantify. So I want to give you some context. There are 195 countries in the world, and there is $100 trillion of combined government debt between them, which means the US alone holds 40% of the total government debt. One country holds almost as much as the next 194 countries. Absolutely crazy. If the US wanted to clear its debt tomorrow, they'd have to tax $117,000 off of every person living in the US. So not every taxpayer, every person, newborns included. Why? Because the US spends way more money than it makes. This year it's projected to spend $2.1 trillion more than it earns, so it has to borrow the difference from somewhere. The way it borrows is by issuing bonds. Somebody hands over cash and the government promises to pay it back later with interest. That's all a bond is. It's a loan with a receipt attached to it. And the cash itself is kind of long gone because they've already spent it years ago on roads and wars and pensions, and what's left is the promise to pay back. So all 40 trillion of that debt is sat in accounts right now. It is earning interest, but it is also carrying massive risk. Because if, or should I say, when the dollar loses value to inflation over the next 10 years, the government doesn't lose a thing. It hands back the same number of dollars it borrowed plus the interest, and those dollars, they just buy way less. The whole loss lands on whoever's holding the debt. So, who holds America's debt isn't really the question. The real question is, who agreed to take the hit? Because over the last 10 years, $21 trillion of that debt has been shifted from one group who doesn't want it to another group that doesn't realize they hold it, that don't realize that they hold all the risk. There are only 3 candidates big enough to take on $21 trillion worth of debt in 10 years. So let's break down each one. Let's start with the obvious one. Foreign governments, China, Japan, the Gulf, the countries everyone assumes are bankrolling America. Now, the US Treasury, which is the government department that actually does the borrowing, publishes exactly who holds its debt monthly on its website. So you don't have to take my word for any of this. I've put it all on a data sheet on my own website, every number in this video and where it came from, and there's a link to it below. Check out the data after this video. So in May of 2015, foreign central banks and governments held 4.17 trillion of American debt. Today they hold 3.85 trillion. So they're holding slightly less right now than they did 11 years ago. No big deal, right? Well, until you realize that over those same 11 years, America's debt went from about 19 trillion to 40 trillion. So the debt pile more than doubled, but foreign governments now hold less. Their share went from around about 23% down to under 10%, and it has fallen every single year. Now, most of them are not actually dumping US debt. They're not getting rid of it. I want to be clear about that because plenty of people say that, but it isn't exactly true. They're just not buying any more of it. So America borrowed an extra 21 trillion and the world's central banks funded almost none of it. So why did they stop? That's the question. There's a lot of reasons, but I want to focus on one of them that accelerated this move away from the dollar. It started in February of 2022 when the West froze about $300 billion of Russia's central bank reserves in reaction to the Ukraine war. Now look, I'm not going to get into the politics of whether this is right or wrong. What matters is that every other central bank on earth watched this happen and said, hold on a second, that could be us. Because their reserves were sat in dollars too, which means the moment they piss off the US, bye-bye reserves. So they started moving their money into the one thing that nobody can switch off. 1,136 tons of gold that year alone, the most since 1967. And they've since bought more gold, enough of it that foreign governments hold more gold than dollars for the first time since 1996. So to be clear, the biggest reserve asset foreign governments held for a long time was US debt, basically IOUs from the US government. Now they changed that to gold. They don't want to lend the US money anymore. So that's lender number one out, foreign governments. They didn't just stop lending to America, they took the money somewhere America can't even reach it anymore, which is why it's costing America more to borrow money today than at any time since 2008. When America borrows for 30 years, like they want a 30-year loan, it has to promise 5.3% in interest just to attract lenders. Back in 2020, the same borrowing cost 1.4%. But yeah, lender number one is gone. They are not interested anymore. So who's lender number two? America itself. A lot of people don't know that America lends itself money. The Treasury asks for a loan, the Federal Reserve, which is America's central bank, just prints the money and hands it over. It's an absolutely mental system when you think about it. Imagine you were spending more money than you earned, and in order to come up with that shortfall, you printed money. You had a magic money printer. I mean, you'd be in jail, but if you're a politician, you'd become Treasury Secretary. Anyway, the US did that for years until it stopped. The Fed's own holdings of US debt went from 2.8 trillion in 2015 up to 6.3 trillion by 2022, which is the money printing everyone remembers during the pandemic. Since then, they've run it back down to 4.7 trillion. So they've lowered their holding of US debt. That's over 1.5 trillion of American government debt that the Fed has pushed back out the door and into somebody else's hands. So this whole borrowing money off yourself thing is crazy. Think about it like this. I borrowed $1,000 off of my mate Bob. Bob wants his money back, but I can't afford to pay him back right now. So I go to ask my friend Mark, Jim, Larry, and Mo for $250 each to pay back Bob. Actually, you know what? Hang on. I've got this wrong. Bob is me. I borrowed money from myself, and now I'm asking Mark, Jim, Larry, and Mo to help pay me back. I know this is confusing, and it should be, because it makes no sense. The whole thing is mental. It also causes massive problems like inflation being one of those big problems. Again, I keep reaching for real world examples, but imagine that you were spending more money than you had. So you printed money to make up for the shortfall. But not only you, all of your neighbors are doing the same thing. Everyone has a magic money printer. Now, everyone has a ton of money, which means that prices of everything around you start going up because everyone has more money to spend. So that's inflation. You have more money, but the money is losing value. Right? The same thing happens when the US prints money to lend itself money. So the Fed stopped printing money, at least temporarily, and America had to go out and find another lender. And it found one that has taken on $21 trillion of American debt without even realizing. Lender number three. Who is lender number three? You've probably guessed this by now. It's you. And you didn't necessarily decide to lend the American government money. Your pension did it. So did the safe cash account you moved your money into when rates went up. And this is bad, by the way. It's really bad because US debt has become a toxic asset. Because despite them paying you interest at the end of the 10 or 30-year term, you end up behind. No one else wants this crap, so they pile it onto you without you even knowing it. I'll show you the maths that proves this shortly, and I'll also show you how to protect yourself. But let's start with how they are forcing this debt onto you. First is through money market funds. If you've never heard of them, I'll explain. You hand your cash over, the fund pools it with thousands of other people's, then lends that pile to the US government. The interest comes back to you minus their cut, and you can pull your money out whenever you like, which is why they get marketed as the safe place to keep your money when you're not investing, and they kind of are, to be fair. They are fairly safe. And chances are you've got your money in one right now. I'll give you a few examples. It's the cash that sat in your investment account when you haven't invested it yet. So it's the money that you've paid in, but you haven't bought anything with it yet. If somebody manages your money for you, a financial advisor or a wealth manager, it's the cash that they are holding on your behalf between making decisions about where to put it. It's the safe option in a workplace pension, the one that people pick when they don't want to take on too much risk. And it's the savings product paying you a few percent that looks and feels exactly like a bank account, but it's not quite a bank account. In every one of those scenarios, nobody leaves your money sitting there doing nothing. It gets parked into a money market fund, so it earns you a little bit of interest. And you just see it on a statement as your cash balance. What it actually is a loan to the US government. 11 years ago, these funds held around about $500 billion of US debt. Today, it's 3.43 trillion. So that's your savings and your spare cash, but they've gone after your pension as well. $7.6 trillion of American government debt is sat inside the federal trust funds. That's Social Security and government employee retirement money, essentially. A pension fund lending to the government that owes the pension. Another example of the government borrowing money from itself. So they didn't stop completely with this whole borrowing from yourself thing. And it isn't just those two, by the way. Mutual funds, the pooled funds your investments probably sit in, went from 709 billion of US debt to 1.69 trillion. Private pension funds also doubled. State and local government pensions nearly tripled. It's all on the data sheet. Every single holder, what they had in 2015, what they are holding now. Go and find out which one you're in. And that's how it happens. It's not some big event. It is them loading on as much of the government's debt onto you as they can, a bit at a time, while you get told that it's the safe option. It will be a big event eventually, and when that happens, you're going to be the one that's left holding the bag. Right, anyway, so I don't want to be all doom and gloom about this, so let's talk about how bad it actually is, because being a lender is not automatically a disaster. American government debt is still the most liquid asset on earth, and the US has never missed an interest payment. I mean, they literally print the money, so it's hard for them to miss an interest payment, but getting paid is not the same as getting ahead. Let's talk about the maths behind this, and you can check this later on the website. All the data is there on the sheet. Take the shortest, safest version of lending money to the American government, the 3-month bill. You lend money to the US for 3 months and they pay it back with interest. Sounds good until you take inflation off of it. Since the year 2000, 59% of all the months lost you money, as in a net loss. The average across the whole period is minus 0.65% a year. And here's what that does to your real money, a real world example. Say you put $10,000 into 3-month government debt. And you did this back in January of 2015, and you rolled it over and over, reinvesting every payment. Your account today would say that you have about $12,700. So you put in $10,000, they paid you interest on top of it, and it feels like you're winning. But that $12,700 buys you around about $8,900 worth of stuff compared to 2015. So when you factor in inflation, you're just way behind. 11 years of doing the safe thing, lending to the most powerful government on earth, and you are down. That's what I mean when I say it's a toxic asset. No one wants it, so they pile it onto you. You can see all of this in the table, what the different lengths of bonds would have returned for you. So check it out on the site. And this is the reset, really. If the US messes a foreign government around by letting inflation run above the interest that they are paying them, the government can just refuse to lend them money anymore. But your pension fund, your money market fund, they cannot. They are built to hold this stuff. That's the whole reason they exist. So once the debt sits with people who can't leave, the cheapest way to deal with $40 trillion of debt is to let inflation grind it down. They force the debt onto you. They pay you interest with the money that they borrowed off of you in the first place. You get poorer every day and they keep spending money. You are the reset. Okay, so you are the reset, but what does it actually mean for you? What can you do about it? First thing is to check what you're holding. Does your pension hold US government debt? Does your 401k? And this isn't just US either. It doesn't matter what country you live in. It's called the global monetary reset for a reason. Your own country's debt is probably just as bad as the US's debt. It might even be worse, to be honest. Now, once you've confirmed whether you're holding debt, you can do one of two things. First is to hold more of it. Okay, I know how that sounds crazy and it's just a bit of a joke really, but there is a little bit of truth to what I just said, because I don't want to be one of these guys that just says cash is bad, buy stocks, only buy stocks. It's not really that simple because stocks are risky. They can go down a lot. The good thing about US government debt is that it is stable and mostly you're just losing a little bit to inflation, sometimes a fair bit. It sounds like I'm trying to sell you on US debt now. I'm not. I'm just making a point. Just bear with me. If you look at your money and you say, hey, most of my money is in the bank right now, then putting your money into US debt is technically better than the bank, because all the bank does is lend your money out and pay you a fraction of what it makes on it. Look at this table. Putting your money in the bank for 11 years would have cost you 28% due to inflation. Buying short-term government debt with it would have cost you 11%. Nobody likes losing money. I'd prefer not to lose 11%, but I'd rather lose 11% than lose 28%. You can also use this table to optimize the debt you hold. Over the last 10 years, holding short-term is better than holding long-term. So the idea is you'd still be losing to inflation. You'd just be losing as little as possible. By the way, this table is based on my calculations, and you shouldn't trust it fully with your life savings. It's an illustration of what holding US government debt versus putting your money in the bank would return. Talk to a financial advisor. The data is real and the calculations are real, but I'm just saying, right? So if you don't want to lose money to inflation at all, then let's talk about step 2. What else can you do? 2 is just don't lend out all your money. Loosely speaking, you can split what you do with your money into 2 categories. You either lend it or you buy something with it. Most people lend their money even without realizing it. If you put your money into the bank, just a savings account, for example, you're lending your money to the bank. The bank takes your money, lends it out as a mortgage or gives it to the US government, and they pay you back a pittance in interest. So most people are lenders, and as we've discussed, lending money typically doesn't beat inflation. You're losing money by lending it out. But buying things does beat inflation, like buying gold, for example. And I don't want to be a gold salesman here. That's not the point I'm making. I'm not saying go out and buy gold. Gold's had an epic run, so getting in now with a lot of money probably isn't the best move. But let's talk about gold for a second. There's this old saying about gold. An ounce of gold 100 years ago would buy you a fine tailored suit. An ounce of gold today would also buy you a fine tailored suit. But if you do the same with money, a tailored suit 100 years ago would cost you like $20, and it costs you a few $1,000s today. That's a pretty good illustration of inflation and how gold keeps pace with inflation. So gold keeps pace with inflation and it often beats it. Cash doesn't. But it's not just gold. Over the last decade, the Nasdaq 100 was the absolute star. The Nasdaq 100 is a stock market index that tracks the top 100 non-financial companies listed on the Nasdaq exchange. Look at this table. It makes it pretty simple. So if you'd put $10,000 into a gold ETF in 2015, you'd have around about $50,000 today. In the S&P 500, which is just the 500 biggest American companies in one basket, you'd be at 54,000 today. In the Nasdaq, which is the tech heavy one, it'd be about $124,000. If you bought a property, your $10,000 would be worth around about $12,000 after inflation. And in US Treasuries, which is what you are being forced to hold, you'd have about $8,700 after inflation. And to be clear, when I say after inflation, this is all accounting for the effects of inflation. What would they have on your money? So for example, with the property, your $10,000 would roughly be worth $20,000 in your bank, but the value comparatively would be around $12,000. So we have to account for inflation when we do these numbers. Now, this varies decade to decade, by the way. Sometimes gold beats the S&P 500 and the Nasdaq, but I'm not telling you to pick any one of these specifically. I'm not saying go buy gold or the Nasdaq or the S&P 500. This is not financial advice. I'm just saying that buying a thing almost always beats lending your money out. But obviously there's a bit more risk in buying something, right? There's going to be down years. And if your retirement happens to fall on a down year, well, that's the risk. You might have to put off your retirement. Or if you retire and then the market halves in the first few years of your retirement, you might need to go back to work. This is why as people get closer and closer to retirement, their portfolio swings more towards government debt versus the stock market or gold and silver. If you want me to do more videos around retirement and retirement portfolios, let me know in the comments below. But in short, this is why you do both of these. You hold debt and you buy stuff. For the debt you're going to hold, just make sure that it's optimized. Hold the shorter term stuff. And for the rest, just buy something with it. Like just buy whatever you want with it. It's not financial advice though. Look into it, talk to a financial advisor. Maybe gold, maybe silver, maybe some stocks, do whatever you want with it. I'll tell you where I sit, by the way, because I'm in the market too, obviously. About 40% of my money right now is in short-term US government debt, and the other 60% is split between stocks and metals. So I'm holding the same thing that I'm calling a toxic asset throughout this whole video, but I'm doing it tactically. I want some cash aside to buy assets like certain stocks, maybe some gold on dips, and it's better that I put my cash in government bonds than it is in the bank, because as we've discussed, I lose more to inflation in the bank. I've put every number from this video on that free page that I mentioned, so go check it out. There's a link to it below. Now go look at what your safe money is actually sat in. Then tell me down in the comments what you found, because I read all the comments and I've got a feeling that most of you are going to be surprised. If you found this video useful, watch this other video for all the signs that you would see before a currency reset. I'll see you in the next one.